Kia ora team, good morning all, excellent to see you bright and early. I said yesterday that we very rarely get fog in the Waikato these days. Remarkable coincidence, 2 in a row. We're really looking forward to today's program, and thanks everybody for a stunning day yesterday, including the dinner for those that could make it. So we're about to be joined by the Governor of the Reserve Bank, Adrian Orr. We will then move into a session on governance and populism. Back then onto monetary policy, the report card looking at the review of the last 5 years. Brief break. They keep coming, Crown Māori relations, sustaining our natural environment, and then finish up with our session on China in the West. So it's a pretty full program for the morning. With the Governor in a moment, he's going to make some remarks. We'll have a small amount of time at the end for questions. So as yesterday, or for new faces in the room or on the live stream, if you're on the computer, click the button for Slido. Otherwise, there are details on your table, and please get questions coming through Slido, or we'll have a roaming mic on the floor. And Adrian, please welcome to the stage.
Well, kia ora tātou katoa, tēnā koutou katoa. Thank you very much for the invitation and to be here, and it's wonderful to be surrounded by the Bulgers again. So a great honour, and everything I have to say, we can blame them, and things should be fine. Wonderful to be back here also at Waikato University. It has sent out some very fine graduates and me. So it's a beautiful place. It's beautiful to be back here as well. Before I start, I also just want to note we've got a couple of members from Pūtea, Matua, the Reserve Bank, in the audience with you as well. James Sargent sitting over here, and Paul Conway. Paul will be up later on. And I note that because I'm very keen that you do get to chat with the bank. We're open, we want to collaborate, we're ready for business, and so we are here. I'd be wrong not to start the address by acknowledging the extreme hardship that many New Zealanders in the Upper North Island are going through at the moment. Our hearts and thoughts are with them, and it is a significant challenge we have ahead for the short term, and I'm really pleased with the agenda, Matt, that sustainability and adaptation is all part of the korero as well over time, so we have really big issues. Today my topic is around about how our work at the Reserve Bank, Te Pūtea Matua, can best contribute to economic well-being and prosperity. I'm going to be reasonably formal because there's a written speech that goes on record. For those who didn't understand my mumbling, you can go and read later. Very good sleep therapy, and it's all there. In terms of contributing to our economic well-being and prosperity, that is our purpose, our raison d'etre, our reason for being, and it is the key opening line of our new legislation that I'll talk you through. I'll chat through about our legislation, our policy remits, and how these commitments shape the very broad work we manage at Te Pūtea Matua, and in particular the trade-offs that we inevitably face from time to time. So it's going to be a lot about optimising subject to throughout the speech. I won't say as you know, because I'm not sure people do know, that we have actually 3 main strands of work at the Central Bank. The first one, of course, is monetary policy. We are the proud monopoly supplier of the fiat currency, the New Zealand dollar. And with that monetary policy, we aim to keep consumer price inflation low and stable through time. It's our desire that the purchasing power of our currency is strong, and that, that the dollar meets the 3 kind of criteria of a currency, that it is seen as a unit of account, a means of exchange, and a store of value. Otherwise, it's not a currency. Of course, we are humble, very humble in our ability to achieve stable consumer price inflation all of the time. Our tools are suitably limited, and there are very long and uncertain lags between what we do with interest rates and the inflation outcomes that are achieved. Meanwhile, economic shocks are just that. For example, in my time as governor, and every governor has their own list, the shocks we've gone through, we've endured the COVID-19 global meltdown, the impact of Russia's invasion of Ukraine, and now, of course, the events impacting the North Island through these severe weather events. These events, by the way, are historically significant. The movements in output, inflation, employment are historically significant as we've gone through this period. We don't determine the context, the economic context we operate in. Instead, we're left to react to that context with those long lags. And we react with a very clear purpose that we state strongly and often, which is aiming for price stability. And our role is to continue to build on a reputation for delivering low and stable inflation expectations. Always forward-looking, always thinking about the context and reacting. That path is well beaten. The second strand of our work, of course, is promoting financial stability. We aim to both lower the probability and the impact of financial institutions and insurers getting into trouble or failing. It's critical for a modern economy that these institutions are able to continuously supply the services to people. They are built on trust and critical to an economy. And then the third main strand of our work is delivering all of the other functions a central bank delivers, ensuring the supply of cash throughout the economy, transactionally banking the banks themselves, and overseeing and operating all of the critical payment and settlement systems. So those latter two roles are often overlooked because of the excitement of the headlines of what have we done with the official cash rate. In delivering on these three strands of work, there is a lot of balancing and trade-offs that we must always undertake and acknowledge. So there's plenty of judgment, there's a wide range of knowledge and inputs that we look and seek for, there's a lot of conventional economic tools we have, and then of course we have our financial capital and our people around the tools and frameworks to try to succeed. Through all of this, we aim to be transparent and understood by the broad public. So we spend a lot of time around transparency that people can see what we're doing and how we came to these decisions. Looking ahead for us, our big challenge is we want to shift, and like everyone does in the Jim Collins world, from good to great. For us to be exceptional, what we're doing at the bank is looking and working holistically across all three aspects of that bank to glean the best data, the best insights, and to best be able to manage the trade-offs, which I'll talk about as we can. So I was thinking about it, in the world of algorithms, when central bankers are replaced by an algorithm, what are we trying to do? Well, we're trying to maximise several objectives, subject to taking no undue operational, legal, financial, reputation risk. I say no undue. There is risk to everything we take. You need to have a risk to get a reward, but it's the undue risk we try to avoid through time. So some of the examples around, that maximising subject to, to bring it tangible, we're asked to pursue low and stable inflation and contribute to maximum sustainable employment, but doing that without creating undue volatility in output interest rates and the exchange rate. So embedded in that simple statement is already two significant balancing acts we need to take. We're asked to maximise financial system soundness while also supporting efficiency, competition, innovation and financial inclusion. We're asked to promote certainty of cash availability while also promoting technology innovation in payments and settlement systems. We're asked to ensure we have robust payment and settlement systems while encouraging competition and innovation. And we're being asked to be the liquidity provider, in an extreme financial event, while also trying to minimise moral hazard and market behaviour, and of course be prudent with our own balance sheet. So you can see through those basic things, there is no one objective function, there are many, and all of them come with subject to, subject to, subject to. So our task is always to build a consistent, coherent, transparent framework that we can explain to the public, our customers, what we're doing and why we're doing it across all aspects of our work. We need to know what the objectives are, what the trade-offs are, and what our risk appetite is to achieving these. I'll put it now into what is our new legislation, and I think it's really important that people do have a look. This is your bank, Te Pūtea Matua, our central bank. So in terms of the hierarchy of objectives that we have, which forms, the basis of the trade-offs and the criteria that we use in our business. At the top of that pyramid is the Reserve Bank Act. It's given the authority to carry out the tasks that I just mentioned through new legislation. There's a new Reserve Bank Act 2021 that came into action mid last year, and it replaced the 1989, the 30-year-old Act. A lot of the stuff is the same, but there are important nuances and differences. This foundational legislation is very clear. Our purpose is to promote prosperity and well-being of all New Zealanders and contribute to a sustainable and productive economy. That is the opening preamble, and it's explicit recognition that the activities we undertake as a central bank are a means to an end. They're not the end in themselves. And so we always have to have that connectedness back to society around promoting a sustainable and productive economy. Underneath the legislation sits our remits. These are negotiated and agreed and signed by the Minister of Finance, their remits. And while we have statutory independence from the government, the remit documents explicitly outline what the government of the day wishes us to take into account when undertaking our three main tasks. We've got a new one, a financial policy remit, and it states, in pursuing financial stability, the government seeks strong institutions, that we have to act with proportionate regulation. They want consistency of treatment across our regulated institutions, maintain competition, and have consideration for efficiency, inclusion, innovation, and amongst all that, have a low incidence of failure of institutions. So we've got the legislation, then we've got this remit. The monetary policy remit, the one that has been around for a long time now, outlines the government's desire for medium-term price stability and maximum sustainable employment, but also ensuring soundness of the financial system and avoiding unnecessary instability in output, interest rates and the exchange rate. So a clear objective function, but lots of secondary criteria that we need to have regard to and be able to explain back to the people how we are doing it. So the remits and the legislation are our guiding North Star. They give us a very clear direction of where we have to go, but they don't tell us how to get there. That is left back inside Te Pūtea Matua and with the board. There's one other stage, actually. We also receive annually a letter of expectations. And again, these are public, they're on our website, and it's another way of the government of the day guiding what would be in our statement of intent, our 5-year ahead, and what they expect to see us being measured against, our statement of performance. So we've got legislation, we've got remits, and we've got letters of expectations. All of that comes together in a hierarchical structure with plenty of guidance. But what is critical to understand is there's no single first, best, optimal calibration of it all. Instead, we are optimising various outcomes over various time horizons, subject to managing other specific risks related to that legal, financial, reputation, operational aspects of our work. And so the algorithm is starting to look quite complex, isn't it? Not sure it's even one algorithm. We're maximising our aims subject to no undue risk. I'll bring it into real-time issues now. I'll start with monetary policy. The best example of a trade-off in action here is where we're required to keep inflation within a target band and support maximum sustainable employment, while also having regard to these other factors: efficiency, soundness, unnecessary instability, and discounting transitory events. Looking through, for example, at the moment, the obvious one is a severe weather condition, near-term price spikes. How do we look through that and focus on generalised inflation rather than jumping to relative price concerns? The first part of the trade-off relates to this dual mandate of low and stable inflation and maximum sustainable employment. mostly there is no trade-off. When inflation is high, employment is strong, unemployment is low, as it is now across all those three variables, it all points to raising interest rates in an effort to slow domestic spending to better match the supply capacity of the economy. So that's all straightforward. But of course, there can and will be trade-offs in the future. If we're faced with, for example, stagflation, I know many in the audience here are fortunately like myself, old enough to remember what that felt like, where you have a period of low growth, you have rising unemployment, but still high inflation, then what do? Do we raise interest rates to slow inflation, or do we lower interest rates to try to maximise employment? So that's where these trade-offs begin to bite. I want to calm the audience because it's without doubt across central banking knowledge, history, economic understanding, that a central bank in that situation has to be resolute to bring inflation down. And we need to bring inflation back to a target range, but of course we need to do it over a reasonable horizon, so as not to unnecessarily crash the economy and turn temporary slower growth into permanent unemployment. So it's a horizon challenge. The second part of the trade-off, of course, is how far and how fast do we rein inflation in without creating that worse outcome overall. Here we need to have regard to these other issues around financial stability and unnecessary volatility, and that's where the balancing act gets really hard. I do recall, I think it was Mervyn King who stated, if your next move with the interest rate is really difficult to make, it means you're probably in a good position at the moment. If your next move is really obvious, you're in the wrong position. So lifting the official cash rate too fast or too far can, for example, lead to a severe downturn. Spending and investment collapses and you end up with a much higher exchange rate because foreign exchange dealers chase the higher yielding in the New Zealand dollar and you crash the export sector. All economies have been through that before. So there's that balancing act between inflation expectations being controlled but not going crazy and crashing the economy. In the financial stability place, we're faced with very similar trade-offs. Our remit says that the government wants a financial system that is strong, efficient and inclusive. As we know, if you want to make a bank strong, you limit the amount of risk-taking they can undertake. However, by doing that, of course, you undermine then the efficiency of the financial system itself. Modern banks and regulators, I say modern, in the last 200 years, realise that lending out deposits is a manageable risk. Likewise, borrowing short-term for the banks, deposit rates, and lending longer terms is also a manageable risk. But we have to accept that risk and we have to be able to manage that risk and accept that this is not a zero failure situation. A very specific example, and one that caused a lot of challenge when it was being implemented, I wasn't governor at the time, is the imposition of loan-to-value restrictions. This limits the amount of high-risk, low-equity loans that you can make to their customers. We don't want too many people, of course, borrowing with no equity to back it up, because any sudden drop in value suddenly puts households in stress, and if it's widespread, it puts the banking system under danger. And we can see that having some kind of constraint on loan-to-value restrictions makes financial stability sense. But of course, it can also significantly impose inefficiency across the system if you take anything too far. A first home buyer may not have the $100,000 they need for a deposit, but they may have a steady job, a good salary, good future income prospects, growing income, and so they could easily honour a mortgage commitment. For them, borrowing would be restrictive if they can't, if you had that restriction on the loan-to-value ratio. And so this is why an example of our risk appetite at the bank is we allow banks to have some high LVR lending, and it's for banks to work out who are the recipients of those high LVR loans. It's not at a zero position. There's plenty of analogies around speed limits on cars and so on and so forth. This is the LVR situation. Banks are allowed to make some of their loans, but not all of their loans as high-risk activity. Financial inclusion, this is a really interesting topic and one that is front and centre for us in our financial policy remit. We all know that financial inclusion is a key input, a key component of economic well-being. It's also specifically referenced, as I said, in our financial policy remit and letters of expectations. We have to have regard to it. We are actively playing a bigger part of our role in financial inclusion. It's involving a lot of analysis and work across places that we haven't been too often to better ensure people can access the financial system and enjoy its benefits. A lack of financial inclusion is not good. It leads to poor availability and accessible, safe financial services. It restricts access to banking, insurance, all of the things that we believe are critical for a modern economy. And it leads to many societal problems. If you're forced to go to payday loans with high interest rates and all sorts of heinous activities, then you have significant societal issues. So we are working with the finance sector and other stakeholders to develop our understanding of what is meant by financial inclusion and really holding a mirror up to ourselves around what are our actions doing to increase or decrease financial inclusion. And our longer term aim is that it just becomes part of our DNA on the way through. For example, I would say, financial inclusion is really obvious for some parts of our work and less obvious, the links are harder. I think about access to cash. Financial inclusion is very critical to core considerations around that, whereas the link between financial inclusion and financial stability are more distant, and we have to think hard around, you could make an incredibly sound financial system by excluding everyone and making no loans, but would that be inclusive? So many examples across our activities that we need to articulate, as particularly around our appetite for actively addressing barriers to inclusion and defining what the trade-offs are. Currently in front of us, we've got significant work around our new deposit takers legislation. This has been going through the House, it'll soon be an act, and in that we have to assess how we will use and operate that legislation, supervising all of the deposit takers and the choices we need to make on regulatory proportionality. By that we mean you can't have the one rule for all because you would end up excluding an enormous amount of efficiency and innovation going on. We're also thinking around financial inclusion with our new role around stewarding within the cash system, producing, storing, distributing cash to the public, and we have to do that with a wide range of participants, the banks, the cash and transit companies, a whole host of folk going on, and inclusion is one of the key principles we're thinking about in our work at the moment, considering a central bank digital currency. So you can see inclusion is important. I'll bring it home. Some communities, for example, rely very heavily on cash and more heavily than other people in their daily life. But ensuring wide access to cash and it's making sure it is accepted in its use is very expensive for banks, businesses and customers. So how do you get that financial inclusion going at the expense of alternative means of transaction? There is a trade-off. We are juggling that efficiency versus inclusion. I do have to say that the recent severe weather events throughout the North Island reminded us again that when the power's off, when you have no telecommunications, physical cash becomes king once again, and then the absence of a means of exchange, a trusted means of exchange, when it's suddenly gone, leads to almost immediate social cohesion challenge. We've seen that globally, and we've been observing that in recent days here in Aotearoa, New Zealand. We also want to make a payment system that encourages and enables innovation. This may be a central bank digital currency. We're working through on that. Love the idea because it fosters innovation, it can reduce costs in banking, it enables faster and more secure payments, and it encourages greater competition. All these beautiful things. But by doing so, you're exposing yourself to new risks, operational risks, reputational risks, because you've got more and more reliance on certain pinch points around technology. So again, the innovation versus the inclusion versus efficiency and soundness are all balancing acts. What are the criteria for doing all of this? Well, our board, our newly empowered board, I'm very proud of it, by the way. The chair of the board, of course, is also the Vice-Chancellor of Waikato University, Professor Neil Quigley. They now have an appropriately empowered board as opposed to an overseeing board. They have to own the risk appetite and make the risk appetite very clear to the public of New Zealand and how they are going to accept risks and manage the trade-offs. They have to understand what the economic underpinnings are of all of our activities, and when we're standing on what I would say facts versus well-held beliefs, beliefs around how economies work, all the different economic models and frameworks. What are those underpinnings and how is that research giving us confidence that those beliefs hold true? So we're working with the board around clarity of our objectives, the understanding of the hierarchy involved across our legislation, our remits and all of these other expectations, articulating our risk appetite statements and what it means and implies across our activities, creating awareness of what facts we stand on when we make decisions, but also building trust in the beliefs that we hold in undertaking our business. And in those beliefs, this is where, I look to the audience, an incredibly well-educated audience. This is where we need help continuously around the research and the challenging and testing around what is the academic or empirical evidence around the beliefs of the work we are doing. It's only then when the board, when the board has clarity on objectives, hierarchies, the risks, facts and beliefs, it's only then a board can sit back and say, we have confidence in the activities that we are doing and we are able to assess the resources we need, financial and human resources, people we need to undertake the activities, and we know when we are being prudent with our balance sheet. So it's a wonderful holistic opportunity that's coming together through this legislation to make all of this happen. Of course, all of these capabilities and capacities will have to change through time, and again they change driven by factors outside of our control. Technology, demographics, societal expectations are changing continuously, and that will change the types of capabilities, capacities, financial resources we need. Central banking is not static, it is dynamic. Of course, bringing all of this together at the shop, underpinning any institution are our values and our culture, and we've been spending an enormous amount of work on identifying the values we need and the culture that will work for us so that we can operate holistically as a central bank across these groups. This is why we introduced a Te Ao Māori framework into our discussions and our work. It's Aotearoa homegrown. It's a link between prosperity, inclusion, sustainability, cohesion. Why wouldn't you adopt a framework that is ready and understood to be able to explain what we're doing and work as a holistic single unit? Building our cultural capability also recognises the unique position, of course, of Aotearoa New Zealand of tangata whenua and the role of Te Tiriti o Waitangi. So, these are both necessary and a critical part of the culture and values and role that we play, and particularly helping us shift from that good to great in that central banking. Building the cultural capability has also provided some pretty amazing and critical insights around an important growing component of the Aotearoa economy. Māori economic activity, the renaissance of Māori business, and some of the unique ownership structures and decision-making structures that go there. And I have to say our recent work looking to improve access to capital for Māori business has been eye-opening, surprisingly too much eye-opening for financial institutions in New Zealand. We have to try harder. We need to serve the people of Aotearoa New Zealand better. And so that is some of the mahi that we're involved in. We're also growing our climate risk expertise, and again this is about understanding the challenges and risks to the economy and the financial system, the risks to the central bank, and our role and the role of the financial system in mitigation and adaptation going forward. The Reserve Bank Act makes it clear we have to have this wider regard, and we would be foolish in any economic sense not to have regard to this work. So looking ahead, and just kind of in conclusion, and this is the whittle that I'll put on the table, this is where we need help to collaborate and work together with the wisdom that is New Zealand's academic great, many of whom are in this room, and I hope some who are online. We have a long tradition of pursuing policy-relevant research. We are a full-service central bank, so not all of our research is around monetary policy. It is across all of the aspects we just talked about, the three strands. Our recent review, and I see it's a topic du jour in an hour or so, the review and assessment of the formulation and implementation of monetary policy. One hell of a mouthful, we didn't come up with that title. The recent review has highlighted some really critical lessons from the last 5 years. At the moment, we have research going on around supply-driven shocks to inflation, demand-driven shocks to inflation, and climate-related risks to inflation. So all of this work is going on, and Paul Conway's there. I'm sure he'll touch on bits of it later on this morning. Our research work on financial stability is also extensive. I've already talked about how we're going to be proportionate in our activity around the Deposit Takers Act, but we're also working on what does an optimal deposit compensation scheme look like. We are now entering the world of the $100,000 maximum payout if a bank fails on your deposit, so on and so forth, implementing that, working on developing and understanding the macro-prudential tools we have. I've talked about the loan-to-value ratio, but we're looking at deposit-to-income restrictions. How do they intersect with our normal prudential tools, capital and liquidity? And what is the optimal calibration of these tools together through a financial cycle? So it is complex work, and remember, we're balancing soundness, efficiency and inclusion. So we have to be optimising across a lot of activity. Our Future of Money program, which is well established now, has seen us engage very, very broadly across New Zealand and internationally, and that's to better understand our money and payments needs across the country. I've talked about the cash, but what about a central bank digital currency? How does that fit around inclusion, efficiency, innovation? These are really, really important topics that we need your help to understand. And we're continuing to work around improving access to capital for small to medium-sized enterprises and for the Māori economy. That's really important mahi, and I believe it will be a big part of unlocking the potential of Aotearoa. A broad range of climate change research is going on, and we're hanging with the best in New Zealand. We're relying on the science from the experts in this field, but we're bringing it into our rohi and thinking about how does it impact on financial stability, what are the roles for the banks and insurers around adaptation mitigation, and how can we provide stress tests. Quite morbidly, towards the end of last year, we ran stress tests for the banks where we had 3 floods back to back in Auckland, and to see what that would do for the banking system. Unfortunately, it turned out to be quite fortuitous, but it's all about raising awareness, capability, capacity within the banking system and insurance activity to manage this stuff. And internationally, we're engaged with the Network for Greening the Financial System, a global network. I think there's well over 120 plus central banks and other financial institutions. We're leading one of the work streams around central bank net zero. We're leading that with the Bank of Italy, and that's around sustainable investment, greening our own operations, but most importantly, developing climate-related disclosures from financial institutions. So in summary, I think you might have gleaned that the world of central banking comes with many, many trade-offs to be made, and there are much uncharted water left out there that we have to get through. And I can't emphasise enough that we are a learning institution, we seek input, we want to collaborate, and that's the whittle that I put on, please come and work alongside us. We need to be doing this on many topics as per the conversations we've had. I think probably the nicest words I can say here is he waka e kanoa, he nari me takitahi te ho. If you want to paddle fast, paddle alone. If you want to paddle far, paddle together. Kia ora, thank you very much.
We've got time for a couple of questions? Or?
Yeah, as long as the audience can suffer them, yep.
All right. Pardon me, quite a few questions have come through and we won't go too long, but first, thank you. Really fascinating oversight for many of us who, you're quite right, we see the announcements on the cash rate, we sometimes don't see the other parts of the operations of the bank. So some of the questions that were coming through picked up on your theme about the trade-offs, the complexity of managing those tensions. And one was, given those trade-offs that are inherently already there, can you provide some clarity on the dual mandate, the current mandate, given, the question says, the poor experience of other central banks pursuing this policy, and I guess I'll extend that, given so many other trade-offs inherent, is it simpler to actually have the single mandate?
No, I think a single mandate has the trade-offs that are expressed anyway in the dual mandate. The short history of New Zealand inflation targeting was that we've always had to have regard to avoiding unnecessary instability in output interest rates and the exchange rate, and we've always had to have regard to where do we believe employment is relative to its maximum sustainable level. That is called potential output. That is the potential growth rate of an economy, and through that output gap type framework, it's always there. So whether you make it explicit in the Pūtea or implicit, that's really a political decision. In reality, it's there.
Thank you. I'll stay then on some of the trade-offs. We'll have a longer discussion with Paul and others on the 5-year review shortly. One question that comes up is, obviously you identified quite a few learnings in there, supply shocks and so on. Given the increase in asset prices and perhaps the unexpectedly small impact on employment and jobs, was there discussion, or why wasn't there a conclusion about there may have been too much stimulus in the earlier parts of the pandemic?
Yeah, I would just invite, and Paul can go on that, I would invite people to actually go and read the document, because generally I get comments from people who haven't actually read our document. And in that document, we talk about monetary policy, whether the impacts were different than anticipated. The answer is no. The biggest surprise was the continuous series of shocks, all in one direction, from COVID, from Ukraine, and now more recently from the severe events. So it's not, monetary policy remains focused over the medium term around price stability, but when you're getting hit with continuous shocks, welcome to the world, the real world we live in. And then within that document, we say, well, what are some of the lessons? Yes, at the margin, we could have started tightening sooner. But even there within the documents, and we show even then, rather than the 7% inflation, it would have been 6 point something. So again, even tightening sooner didn't really change the fact that we are well outside of the inflation target, as is every other OECD country, because of the nature of the economic shocks.
Thank you. Can I, there's a question here on composition of Monetary Policy Committee, and I might come to that in a moment. When you run us through that list of trade-offs that you're facing, at an operational level, can you give us a window into the frameworks you and the team use to actually go through that number of, legislated remits, other things, letters of expectation? How do you, at an operational level, week to week, day to day, run through those trade-offs and analyse the impacts?
Yeah, I'll try and say it very simply. The first thing, of course, is not all committees are involved on all the one topics. So we have dedicated efforts around Financial Stability Committee, the Monetary Policy Committee, the Payment and Cash Settlement Committees. So very dedicated resources with their own objective functions, with clarity around the criteria they must try and maximise those objective functions around. I'm sorry, sounding so bland. And increasingly a more explicit awareness of the risks they have to actively seek to achieve those outcomes. So once you've got that very clear, it doesn't become as complex as it sounds. If you don't have those clear, then how do you know you're optimising, and how can you truly explain to the public what you're actually doing, and how do you know if you've got the optimal resources, the appropriate skills, the balance sheet, etc., to achieve those outcomes? So that is the clarity that we need. In the central banking world, that clarity has been long held, in modern times at least, for monetary policy. The Monetary Policy Committee, the projections, the horizon, all of those tools and things that people are used to. Financial stability has been more complex. It's a very heterogeneous topic. There's many different facets to it. And so bringing that under one type of umbrella is a real important challenge for the bank ongoing. It's been a poor cousin, prudential regulation. It's now holistically being thought about around financial sides. And, cash and payment and settlement systems, I would say at the Reserve Bank that was seen as the folk that just shift trolleys around down in the basement and do physical cash. Yet it's at the core of our essence. It's the sap in what we're doing. So again, bringing that into that holistic picture around a means of exchange, how is that going to be able to enhance societal behaviour?
Mm. Okay, that's a...
Sorry, waffling, but...
No, it's a great one to go into, and I think next year we're looking at launching a Bachelor of Financial Technology, FinTech, here at the university and at the management school, because it's such a critical topic, ranging from back office clearinghouse functions right through to central bank digital currencies, the CBDC. Yep. Can you explain to us, great illustration there, when the system goes down, when the FPOS doesn't work, when you need supplies, it's a flooding situation. This is just happening last week. Can you talk to us, though, what might a central bank digital currency look like? I think for some of us, it's hard to actually understand what that means. We can already pay with our phones. What would be different? So
I'll just start on that first bit. Resilience, is word du jour around the world, and certainly here in Aotearoa, New Zealand at the moment. Resilience was around supply chains falling apart during COVID. Resilience now is about almost all activities in New Zealand, from the Cook Strait ferry through to getting cash out of an ATM. We are so thinly spread. It's all just in time. There's no just in case mentality going on in corporate society, and so we need to build up that resilience. We need to have, in the simple cash management side, yes, you may not use it day to day and all the time, but when you need it, it has to be available and immediately. So what are we doing around increasing that resilience, the availability of cash, the ability to store cash across regions, so on and so forth? That is critical. And a central bank digital currency is not going to remove the need for that resilience. You are going to have to be able to operate without power and without communications and without the law of the gun deciding who gets the loaf of bread. So that is critical. A central bank digital currency, meanwhile, is simply an electronic signal that sits in the central bank that says, I owe you something. So it's no different to an electric signal that sits in a retail bank, except this time it's with the central bank, and because it's with the central bank, it's narrow money. It is the true fiat currency rather than broader money created by the retail banks themselves, through fractional banking. So it's the equivalent of having a physical $1, a physical note. You've got an electronic signal with the same inside a high-powered one-to-one relationship. We all know this, and I don't want to create a sudden rush for the door if you're just realising it, that if we all went to try and take all of our deposits out right now, the banks wouldn't have it. They lend out far more than they physically hold, and that's fractional banking. But with the one-to-one central bank digital currency, it's there. It's backed by the Crown balance sheet, current and all future taxpayers. So that's the idea. Who holds that electronic signal is the really critical part. Does a central bank hold it and bank everyone transactionally, or does the central bank allow retail banks to hold that electric signal and customers have a choice between Bank A money or central bank money on their accounts? How do they split those two? So that is where it gets important, because a central bank is not the risk allocator of capital around. That is done through the very important role of banks are to allocate that capital on a risk-based manner. So it's so simple at the heart. What makes it different to a Bitcoin or to a stable coin? Well, it's the central bank's money. It's not someone else's IOU or I promise. It's not Zuckerberg's promise or around I'll be good for it if you ever need it back. It is a fiat currency promise.
Thank you, that's really useful. I'm just going to check, are there any questions from the floor? Yes, we'll just wait for a microphone.
And then I'm going to have to hold there.
Yeah. This is probably the last one.
Better be good.
No pressure.
Kia ora, Adrian.
The answer, I meant.
Yeah. So, given that you've been talking about digital currency, and so we're looking at the balance sheet of Te Pūtea Matua, are you having any issues that the Deutsche Bundesbank is currently having with a very bad P&L with all their very low-paying bonds that they're holding? Is that something that's emerging for Te Pūtea Matua?
Well, I notice an emotion there. You use the emotion bad. What is the balance sheet of a central bank? The central bank doesn't even need equity. We print the stuff. So it's the world where accountants have met the world of economics, and at the moment, central bank mark-to-markets around the world are either positive or negative. It doesn't make any difference to the actual central bank unless somehow their credibility is being attacked, i.e. You're printing money with no sense of ever making it low, stable inflation through time. So that's the Venezuela or the Zimbabwe or the Argentina. Meanwhile, central banks who are committed to low and stable inflation and have that credibility, the equity in the balance sheet is effectively noise. So, but wow, it looks different. Oh, I haven't seen that before, and I was told in accounting, you must have positive equity in this. So it hurts the brain, but you need to exercise that brain, and there's some wonderful reading around central bank balance sheets. The BIS are out on their public mission at the moment to explain to people, calm down, it's okay. I love the US Federal Reserve's balance sheet. They are always square at the end of the day because the way they do it is their equity is the discounted future seniorage that they get. And so magically it balances off each day. I'll let you think about that.
Sorry, my point was actually more the P&L. I know the Deutsche Bundesbank was, obviously pays out surpluses and it pays deposits for its retail banks. It's got into a position where, in fact, the money that it's earning of its portfolio is significantly less than the deposit money it's paying out. I mean, again, it could well be just an accounting issue rather than a real issue, but it's certainly something that's quite live.
It's making headlines. It's a reputational challenge. That's about balancing reputational, operational, financial and legal risk. Reputational, if you've said our reputation is based on us having positive capital and then you don't, well, you've got some explaining to do. The Reserve Bank is quite unique, and I won't say optimal, it's just unique at how it is. We were given a slug of capital and we're told to pay dividends, anything over, above or below that capital. But quite what that capital means, I'll leave it to the BIS to explain to the public. Kia ora, thank you.
All right, thank you, Adrian. Much appreciated.
Cheers. Wonderful.
All right.